Namaste and welcome to the Finwell Daily Brief. It's Tuesday, April 1st, 2025.
April Fool's Day.
You know it. This is actually our 11th briefing.
11 already.
That's
Wow.
how, right? Time flies. But anyway, we're focused on the Indian financial markets today, bringing you all the action right at the close, 3:30 p.m. Basically, cutting through the noise and getting straight to what matters.
Exactly. And I think it's particularly interesting today because we've got this mix of domestic and international influences all playing out at the same time. Should be a good one to untangle.
Definitely a lot to unpack. So we're going to start with a fascinating trend among Indian investors. Then we'll break down those closing bell numbers, the Nifty, the Sensex, and all that. Plus, the big economic news of the day. And of course, we'll finish up by looking ahead.
Sounds good.
All right, so let's jump right in with this really interesting story, right? Indian retail investors are really stepping up their game when it comes to disciplined investing. We're talking about SIPs, systematic investment plans.
Yeah, SIPs.
The monthly contributions to these have crossed, get this, 19,000 crore.
Wow, it's huge.
Huge is right. Now, for anyone who might not be familiar, SIP is essentially like setting up a recurring automated investment, right? You choose a mutual fund, decide how much, and it just ticks away in the background.
Very convenient.
Totally. So what I'm curious about, seeing this surge in SIP contributions, what does that tell you about the overall sentiment, the feeling among investors right now?
It's really quite encouraging, actually. I think it points to a real shift in the investment culture here in India. People are starting to understand the power of consistency, of staying invested for the long haul. It's not just about chasing quick returns anymore.
Right.
And it also suggests a certain level of confidence, wouldn't you say? Despite all the ups and downs, the global uncertainty, people are still putting their money in.
I think you're spot on. It's about trusting in the India growth story. But speaking of ups and downs, well, today was definitely a down day. The Nifty 50, that's our benchmark index for the top 50 companies, closed at 23,165.70. That's a drop of 353.65 points.
A good 1.50%.
1.50% decline, exactly. And it wasn't just the big guys. The Nifty Midcap 150, representing those mid-sized companies, also took a hit, closing at 18,931.4, down by 188.95 points, so just under 1%.
0.99% to be exact.
There you go. And even the smaller companies, the Nifty SmallCap 250 finished lower at 15,030.7, a decrease of 73.95 points. That's a drop of 0.49%. And just to complete the picture, the broader Nifty Total Market Index settled at 11,842.75, down by 142.15 points. We're going to see classic risk-off day. Investors are feeling cautious, maybe even a bit spooked by some of the news we've seen recently.
Makes sense. And I think the fact that the Nifty 50, those big blue chip companies, fell more sharply than the smaller indices could be a signal. Could be telling us that the bigger investors are more concerned about things like, I don't know, maybe that big government borrowing announcement we're going to talk about in a bit.
Interesting point. And maybe there's a sense that small caps are more insulated from some of these global pressures, more focused on domestic themes.
Could be.
All right, so let's shift gears a little. Let's talk bonds and currencies. Now, the 10-year Indian government bond yield stands at 6.65%, which is interesting because that's actually down a bit from last week. We were at 6.73% then.
Right.
At the same time, the rupee has weakened slightly. It's trading at 85.80 against the US dollar compared to 85.7050 in the previous session. So help me connect the dots here. You've got this slight easing in bond yields and this depreciation of the rupee. What's the relationship there?
Well, I think there are a couple of things at play. First, the bond yields, that little dip could be because the market is anticipating that inflation might ease up a bit. And if that happens, well, the Reserve Bank of India might start thinking about cutting interest rates.
Okay, so lower inflation, potentially lower rates, that makes bond yields a bit more attractive.
Precisely. Now, when it comes to the rupee, that's a different story. The rupee's a little weaker, and I think that's tied to a couple of factors. First, the U.S. recently announced those new tariffs on automobile imports. And that's made investors a bit jittery globally. And when that happens, the U.S. dollar tends to strengthen. It's seen as a safe haven, right?
Right, a safe haven.
And then the other thing is we're getting close to the end of the fiscal year. And there are always some currency adjustments happening around this time. Businesses and institutions are wrapping things up, balancing their books, and that can affect demand for the rupee. So basically, you've got these sort of competing forces pulling at the rupee.
Okay, so it's a complex picture.
Definitely nuanced.
So let's move on to the news that really shaped today's market action. Big announcement from the Indian government. They're planning to raise a massive euro 8 trillion by selling bonds between April and September.
Oh, wow.
And to give you an idea of the scale of this, that's 54% of their estimated gross borrowing for the entire fiscal year. And the goal here is to manage that fiscal deficit, which they want to keep at 4.4% of GDP for the fiscal year 2025-26. And I'm talking directly to you, the listener. Why should you care about this announcement?
I'll tell you why. Because when the government borrows this much money, it can have a real impact on your pocketbook.
How so?
Well, think about it. When the government issues a ton of bonds, it increases the supply of those bonds in the market.
Right, supply and demand.
Exactly. And when the supply goes up, well, the price can go down. And in the case of bonds, the price is reflected in the yield, the interest rate. So potentially, bond yields could go up.
Yeah.
What does that mean for you? Well, it could mean that borrowing costs in general, whether you're looking to buy a home, a car, or even if you're a business owner looking for a loan, those costs could go up.
Okay.
And it's not just about borrowing. If you're invested in fixed income instruments like bonds, well, the returns you're getting could be affected too.
I see. So there's a ripple effect.
Definitely. And on top of all that, this huge borrowing program could affect the overall liquidity in the financial system. So yeah, something to keep a close eye on.
Definitely something to watch. Now, shifting gears a little bit, a recent Reuters poll suggests that the Indian rupee might actually reverse its recent gains against the US dollar. And we could potentially see it sliding back towards historic lows over the next year. Yeah. They're citing a potential slowdown in India's economic growth and the belief that the US dollar's recent weakness might be coming to an end. So what's your take on this? Do you think the rupee's in for a rough ride?
Well, predicting currencies is always tricky, right? But this forecast definitely raises some concerns. And I think it highlights how interconnected the global economy really is. If the U.S. economy starts to pick up steam again, the dollar could strengthen, and that would put pressure on the rupee.
Right. And a weaker rupee has implications for all of us.
Absolutely. It makes imports more expensive, which can lead to inflation. And that means everything from fuel to electronics could cost more. Of course, a weaker rupee can also make Indian exports more competitive, so there's a potential upside there. But overall, it's definitely something to monitor, especially if you're involved in international trade or if you're holding assets in foreign currencies.
Okay, good points. Now, we also can't ignore the impact of what's happening on the global trade front. The U.S. president recently slapped new tariffs on automobile imports.
Right.
And this has definitely made investors nervous, both globally and here in India. It has the potential to disrupt trade flows and impact Indian export-oriented sectors, particularly those in the auto industry. So I'm thinking of our listener who might be thinking, okay, what does this mean for me? How should they interpret this development?
Well, I think the big takeaway is that global events can have very real consequences for individual investors. If you're invested in a company that exports a lot of cars to the U.S., for example, these tariffs could hurt their bottom line.
Right, lower demand, lower profit.
Exactly. And it's not just investors. If you work for a company that's heavily reliant on exports, these tariffs could potentially impact jobs as well. So it's definitely something to be aware of.
Absolutely. Now, on a more positive note, foreign portfolio investors have actually been net buyers in the Indian equity market lately. In fact, they recently scooped up $352.8 million worth of Indian bonds. So this seems to indicate that at least some investors are still pretty optimistic about India's economic prospects.
Yeah, that's a good sign. I think it shows that despite all the noise and uncertainty, there's still a fundamental belief in the India growth story.
Yeah. But it's interesting, right? Because you've got these positive foreign inflows, yet the market overall was down today. So how do we reconcile those two things?
Well, markets are complex, right? They react to all sorts of things in the short term.
Yeah.
So today's decline could be driven by, I don't know, maybe profit-taking, maybe concerns about that government borrowing program we talked about earlier. But in the long run, these foreign inflows suggest that there's still underlying support for the market. It's kind of like a vote of confidence from outside.
I like that analogy. Okay, last bit of news for today. The 10-year bond yield dipped slightly, and this is partly due to easing local inflation, which is good news.
Definitely good news.
And there's also growing expectation that the Reserve Bank of India might cut interest rates again in April. So how does this all affect the average listener?
Well, easing inflation is great for everyone.
Right.
Because it means prices aren't rising as fast.
Right, more money in your pocket.
Exactly. And when it comes to a potential rate cut, well, that could mean lower borrowing costs, which is good news if you're thinking about taking out a loan for a house or a car. but it could also mean slightly lower returns on your savings accounts or fixed deposits. So it's a bit of a mixed bag, but overall, I think it's a positive development.
Okay, so to sum it all up, we've had a lot to digest today. The market was down. Bond yields eased a bit. The rupee weakened slightly. The government announced a huge borrowing plan. The U.S. imposed new tariffs. Foreign investors are still buying Indian assets. And inflation is easing. It's a lot, right?
Quite a lot.
So if you had to pick one key takeaway for our listener, what would it be?
I think the key takeaway is that you can't just look at the markets in isolation. You have to understand the bigger picture, the forces that are driving these movements both domestically and globally.
So you're saying it's all connected?
It's all connected. The government's fiscal policies, global trade dynamics, foreign investment flows, they all matter.
And it's up to each individual investor to make sense of it all.
Exactly. Knowledge is power.
Couldn't agree more. Now, let's talk about specific sectors for a moment. The automobile industry, for example, is facing a lot of uncertainty because of those new U.S. tariffs.
Yeah, that's a tough one.
And the banking and financial services sector, they're going to be watching the government's borrowing program very closely because that's going to impact liquidity and interest rates. So what are some of the key investment themes or sectors that our listeners should be paying attention to right now?
Well, I think it's worth keeping an eye on sectors that are closely tied to government spending. Infrastructure, for example. Because if the government is borrowing heavily, they're likely to be spending on infrastructure projects. And that could create opportunities for investors.
Good point.
I'd also keep close watch on export-oriented sectors, especially those that are heavily exposed to the U.S. market. See how they're navigating these new tariffs.
And what about foreign investment flows? You mentioned that earlier.
Yeah, I think it's important to track those trends. Are foreign investors continuing to pour money into India? Or are they starting to pull back? That can tell you a lot about market sentiment.
So those are the key areas to watch: government spending, export sectors, and foreign investment flows.
Yeah, those are good starting points.
All right, well, we've covered a lot of ground today. Clearly, the Indian financial markets are in a very dynamic phase right now. You've got domestic policies, global events, all sorts of factors shaping the landscape. So any final words of wisdom for our listener?
Just this. Stay informed, stay engaged,
Yeah.
and don't be afraid to ask questions.
Couldn't agree more. Knowledge is key, right?
Absolutely.
Well, if you're looking for more insights and analysis on the Indian financial markets, be sure to subscribe to the Finwell Daily Brief.
Yeah, subscribe.
And connect with SOS Finwell on LinkedIn. We're always sharing valuable content and engaging in discussions about the latest financial trends.
Definitely connect.
And if you have any questions about anything we discussed today, please reach out to us on LinkedIn. We love hearing from our listeners. So subscribe, connect, and let's keep the conversation going.
Sounds good.
And remember, as Warren Buffett once said, risk comes from not knowing what you're doing. So stay informed, invest wisely, and we'll see you next time on the Finwell Daily Brief.
See you next time.
Namaste.